Welcome back to the FundaTech Insights, the podcast where we chew through stock stories faster than your average fast food drive-thru. I'm your host, and today we're diving into a flavorful name, CAVA Group Inc., ticker CAVA. Joining me to pick apart their business, financials, and where the stock might head next is our resident analyst, Maddie. So, Maddie, how's it going?
Hey, doing great. And honestly, I'm a little hungry after all this talk of Mediterranean bros. Let's hope we can serve up insights just as tasty.
So, Maddie, tell us about CAVA. What exactly do they do? Are they more pita or more plates?
Good question. CAVA Group, trading under CAVA on the NYSE, is a fast casual restaurant chain in the consumer discretionary space. Their game is Mediterranean flavors. Think bowls, pita, and spreads, with a modern twist. They're not just opening restaurants. They've got a robust digital ordering business and even a branded grocery line. In short, they're not just another random quick bite place. They're building a mid-bowl empire.
All right, so the stock, how's it behaving? Is it cruising on autopilot or doing loop-de-loops?
As of late November 2025, CAVA was trading around $48, $49, but earlier in this window, it spiked intraday by as much as 8 to 15%, depending on where you looked. It was one of those blink and you might miss it moments.
Right.
Their market cap is about $5.6, $5.7 billion, which means they're not exactly a small fry. Daily volume ran around 8 to 9 million shares, while their 20 to 30-day average sits closer to 4 to 5 million. So there's definitely some liquidity. But when big news hits, the stock can move fast.
Spicy news, Maddie. What's been cooking at CAVA recently?
Oh, plenty.
Really?
Yeah. Their Q3 2025 earnings came out in early November, and it was a mixed plate. Revenue reached $289.8 million, up 20% year over year. That's solid growth, especially for a concept that's scaling quickly. Adjusted EBITDA was $40 million, and net income came in at $14.7 million. Not bad at all.
That's good. What about sales?
Same-store sales grew by 1.9% though, which was a little softer than some bulls hoped for. To add spice, management downgraded full-year same-store sales guidance to 3 to 4% from a previously more aggressive forecast and raised their expected pre-opening costs to $18 to $19 million. Their adjusted EBITDA guide for the full year is now $148 to $152 million. It's not that they're backing away, more like they're being realistic in a delivery-heavy, labor cost-heavy environment. So they're not exactly handing out shawarma for free. Anything else stirring the pot?
Yes, digital sales are a big deal for them. In Q3, about 37.6% of their total revenue came from digital channels, which is huge.
Yeah, this is huge. That means they're not just relying on foot traffic. Also, the company continues aggressively expanding. They opened 17 net new restaurants in that quarter, bringing their store count to around 415 nationwide. Plus, not to be overlooked, they've got their CAVA shop for merchandise and grocery items, pushing their brand into retail.
Now, on to the money talk. Are they making it rain hummus, or is the financial fountain a little dry?
Their Q3 results were fairly encouraging. As I said, the $289.8 million, $40 million in adjusted EBITDA, net income of $14.7 million, and that 1.9% same-store sales growth. Restaurant-level margins remain pretty healthy, and their unit economics for new restaurants are attractive, especially as their new stores have been productive.
What does that mean?
That said, there are margin pressures. Delivery costs, wage inflation, and supply chain expenses are niggling. That's partly why they raised their expected pre-opening costs. So for FY 2025, they're guiding 68 to 70 new restaurants, 3 to 4% same-store growth, and $148 to $152 million in adjusted EBITDA. It's growth, but with a side of caution.
Time to put on the technical analyst hat. Is the stock a smooth pita, or is it cracking at the edges?
Currently, the chart shows that CAVA is trading well below its 50-day moving average, which sits near $58 to $60, and way below the 200-day, which is even tougher territory, roughly $79 to $81. That puts the stock in a precarious technical spot. It's not riding any trend momentum upward right now.
What about support and resistance?
In terms of support, there's a real floor around $42 to $46 where it's bounced before. If that fails, we might see levels near $39 to $40 tested. On the resistance side, the first hurdle is 48 to 52, then a steeper climb to 62 to 70 if things really heat up. Momentum indicators like RSI are showing oversold conditions in some charts, so a bounce to $48 to $52 is quite plausible. But for a sustained breakout, they really need to reclaim the 50 and maybe even the 200-day moving averages. So, in short, tactical traders might try to scalp a bounce, but long-term play needs serious technical confirmation.
Okay, so what about squeeze?
There's definitely retail interest. Short interest is not trivial, around 14.3 million shares short, which works out to about 12 to 14% of the float. The days to cover ratio is nearly 3.8, 3.9, so squeezing is possible, but it's not a guaranteed gamma rocket. Institutions own a hefty chunk too, which mutes the risk of a full-blown meme squeeze.
So, Maddie, if I were to sum it up with the side of humor, is cover the next big Mediterranean money machine or just a bowl that's half full?
I say it's a mostly full bowl. There's real substance, strong growth, digital strength, and unit economics that appeal. But there's also a drizzle of caution, margins, cost headwinds, and ambitious guidance. For the long haul, I lean bullish, assuming they execute. But short term, be ready for volatility. If you're investing, you probably want a multi-quarter view. If you're trading, pick your moments carefully.
All right, that's all for today's episode of FundaTech Insights. Remember, folks, this isn't financial advice, just mildly entertaining market therapy. Catch us in the next episode when Maddie explains about next stock. Till then, take care of yourself. Bye-bye and keep investing.